Dominic, thanks very much. The Federal Reserve generally giving banks a clean bill of health here amid this coronavirus health and economic crisis that we're in the middle of. The Fed saying in its Bank and Supervisory Report for May that banks were healthy coming into 2020. Right now, banks can absorb higher losses due to stronger capital and keep lending despite the problems going on in the economy. They do say capital ratios were down, but for most banks remain well above regulatory requirements. And if you're listening to this, think about the contrast of how this report might have sounded in 2008, 2009. That's really the big difference here. Banks, they say, the Fed says, have a healthy liquidity position. They do face operational challenges of running banks with a lot of their loan officers and key personnel in different places, but they seem to be managing that. Now, loans and deposits surged in March. That's a key point because what happened was a lot of businesses drew down their credit lines. A lot of people went scurrying for the safety of banks. Again, big difference from the financial crisis. They say strains in the bank funding market, which the Fed addressed through trillions of dollars of liquidity, have eased somewhat. Now, there will be some additional, not maybe formal stress testing, but additional testing of the banks to see how they're weathering this system. So right now, Dominic, I think the story is that amid this economic crisis we're going through related to the health crisis, the banks remain relatively healthy, able to help the economy through it. But I guess the answer is so far, with 20 million unemployed Americans, certainly the strains on the banks will increase there. Dominic?
All right, those banks a key focus there as well. Thank you very much, Steve Liesman, for those headlines on the Federal Reserve.